Alright team, settle in. Grab your coffee, your inflation-hedged assets, and a stiff drink, because today we're diving headfirst into a story that is so perfectly, beautifully, tragically on brand for the world of international finance that you'd think it was written by a satirist. But no, this is real, well, hypothetically real for our purposes today. The date is September 27, 2025. And the headline is a certified banger: the Trump administration readies a $20 billion lifeline for Argentina. You gotta love it. It's the sequel nobody asked for, but everyone in our line of work knew was inevitable. It's like seeing your friend who swears they're done with their toxic ex get back together with them for the 8th time. You just sigh, shake your head, and get ready to hear all about it. Today, we're not just going to read the headline. We're going to put on our X-ray goggles and look straight through this deal, from the surface-level political handshaking, down to the tectonic plates of geopolitical strategy and the molten core of economic risk. We'll unpack why this isn't just a loan, it's a geopolitical poker chip, a high-risk gamble with taxpayer money, and the latest episode in the century-long tragicomedy that is Argentina's economy. Let's get into it. So, here's the skinny. The year is 2025. President Trump is back in the White House. His Treasury Secretary, a hedge fund guy named Scott Bessent, is floating a $20 billion rescue package for Argentina. The target of this affection? President Javier Milei, the libertarian anarcho-capitalist who came to power with a chainsaw and a promise to dollarize the economy and dismantle the state. The immediate goal is crystal clear, and it's got very little to do with sound economic policy. It's about politics. Milei is facing crucial midterm elections, and the markets are, to put it mildly, having a panic attack. The Argentine peso is doing what it does best, impersonating a rock thrown off a cliff. So, Team Trump wants to build what Bessent calls a bridge to the election. Think of it this way: Milei is their guy, their ideological ally in South America. He's the poster child for their brand of free market, anti-establishment politics. A win for him is a win for them. So, the US Treasury is essentially becoming the world's most powerful super PAC, offering a $20 billion campaign contribution with extra steps to keep their man in the game. The tool for this financial wizardry? A dusty old piggy bank called the Exchange Stabilization Fund. We'll get into the gory details of the ESF later, but for now, all you need to know is that it's the Treasury Secretary's personal slush fund for meddling in currency markets, and it doesn't require pesky congressional approval. It's the financial equivalent of a diplomatic black ops mission. So, on the surface, it's a simple story: America helps a friend. A powerful nation stabilizes a struggling ally. But as we know here at Boss Economics World, the surface is where the suckers live. Let's drill down. To understand why this is such a monumental gamble, you have to understand that we've seen this movie before. In fact, we've seen two different versions of it, and the Treasury is hoping everyone only remembers the one with the happy ending. The precedent they're all pointing to is the 1995 tequila crisis bailout of Mexico. Back then, President Clinton used this very same ESF to push $12 billion to Mexico to stave off a catastrophic default. The commentariat screamed about risk and moral hazard. But you know what? It worked. Why? 3 key reasons. 1. Collateral: the loan was collateralized by Mexico's oil export revenues. This was a hard, dollar-denominated asset. It was like lending money to a friend but holding the title to their brand new car. 2. A clean slate: Mexico, while in crisis, didn't have the same soul-crushing, multi-generational debt baggage as Argentina. Their balance sheet was messy, but not a complete write-off. 3. Currency reset: the Mexican peso had already crashed before the bailout. This meant the painful part was over. The cheap peso made Mexican exports super attractive, leading to an export boom that helped them repay the loan. The result? The US got all its money back, plus a cool $500 million in profit. It was a masterclass in financial statecraft. This is the story Bessent and Trump are selling. Now, let's talk about Argentina. Argentina isn't just a friend who needs a loan, it's the friend who has totaled every car you've ever co-signed for. The country has defaulted on its sovereign debt 9 times. Let that sink in. 9. In 2018, during Trump's first term, the IMF, with strong US backing, gave Argentina the largest loan in the fund's history, $57 billion. The goal was to support the then market-friendly president, Mauricio Macri. What happened? The money vanished into the black hole of Argentina's fiscal deficit and currency support. Macri lost the election, the Peronists returned, and the country defaulted again in 2020. As of today, in our hypothetical 2025, Argentina is still the IMF's biggest debtor, owing something in the ballpark of $42 billion. They are, for all intents and purposes, completely locked out of traditional credit markets. The IMF is tapped out and likely facing internal revolt over throwing more good money after bad. So when Brad Setzer, a former Treasury official, asks, why will this $20 billion make a bigger impact, he's not just asking a rhetorical question. He's pointing out the insanity of repeating the same action and expecting a different result. The 2018 bailout was more than double this proposed amount, and it failed spectacularly. Unlike the Mexico case, Argentina's balance sheet is a disaster zone. And crucially, as the article notes, the peso is widely considered to be overvalued by at least 20%. Milei has been burning through reserves to prop it up, a classic and always doomed emerging market strategy. This means a painful devaluation isn't a risk, it's a certainty. The only question is when. Let's pop the hood on this deal and look at the engine they're using, the Exchange Stabilization Fund. The ESF was created in 1934 to allow the Treasury to intervene in currency markets. Think of it as a pool of assets, mostly US dollars, but also foreign currencies and special drawing rights that the Treasury Secretary can deploy with remarkable discretion. It's their break glass in case of emergency fund. The proposed deal here isn't a simple cash loan. It's likely a currency swap. Here's how it works in layman's terms. The US Treasury's ESF gives Argentina $20 billion in solid, reliable, universally accepted US dollars. In return, the Central Bank of Argentina gives the ESF the equivalent amount in Argentine pesos, or perhaps some peso-denominated government bonds, as collateral. See the problem? The US is trading a Ferrari for a receipt that says I owe you one Ferrari. This is fundamentally different and far riskier than the swap lines the US Federal Reserve has with trusted partners like the European Central Bank, the Bank of England, or the Bank of Japan. Those are swaps between institutions that print the world's most stable reserve currencies. It's a transaction between equals. The ESF Argentina swap is a transaction between a superpower and a serial defaulter. The primary risk is exchange rate risk. Let's run the numbers. Say the swap happens at a rate of 1,000 pesos to the dollar. The US hands over $20 billion and gets 20 trillion pesos in collateral. But everyone on Wall Street, in Buenos Aires, and probably in a remote Amazonian tribe knows the peso is on life support. If Milei's election gamble fails, or if reality simply reasserts itself, the peso could easily fall to 1,500, 2,000, or more to the dollar. Suddenly, that 20 trillion pesos of collateral is no longer worth $20 billion. It might be worth $13 billion, or $10 billion. The US Treasury is left holding a bag of rapidly depreciating currency. This isn't like the Mexico deal where the collateral was oil revenue, a commodity priced in dollars. Here, the collateral is the problem. This is what experts mean when they say the Treasury would be on the hook. It's a direct risk to the US taxpayer. While the ESF's gains and losses don't directly hit the annual budget, a significant loss would deplete a key tool of US financial power and represent a very real loss of national wealth. So if this is such a bad economic bet, why on earth would the US make it? Because this isn't about getting a good return on investment. This is about the great power competition. We're talking about the US versus China. The provided text gives us a crucial clue. Argentina also has a central bank swap line with China. For the past decade, China has been quietly and effectively using its financial muscle to build influence across the developing world. Through its Belt and Road Initiative and its network of currency swap lines, Beijing has become a lender of last resort for countries locked out of Western financial institutions. They offer loans with fewer strings attached regarding human rights or democratic reforms, but with very real strings attached regarding political loyalty and access to natural resources. Argentina has already activated billions from its yuan swap line with the People's Bank of China to make payments and manage its finances. In 2023 alone, it tapped $6.5 billion from this facility. From Washington's perspective, this is a five-alarm fire. Having a major South American economy, a G20 member, no less, become dependent on Beijing for financial survival is a strategic nightmare. It undermines the Monroe Doctrine, challenges U.S. influence in its own backyard, and, most importantly, chips away at the global dominance of the U.S. dollar. Every time Argentina uses the yuan to pay its debts or conduct trade, it's one small transaction that doesn't use the dollar. Multiply that by dozens of countries, and you have a slow-motion challenge to the very foundation of American global power, the dollar's status as the world's reserve currency. So, this $20 billion isn't just for Milei. It's a flashing neon sign to the rest of the world that says, the dollar store is still open for business. Don't go running to our competitor. The Trump administration is willing to take a high-risk bet on Argentina to prevent it from falling deeper into China's financial orbit. It's a defensive move in a new kind of Cold War, one fought with balance sheets and swap lines instead of tanks and missiles. The risk, as former IMF official Doug Redeker points out, is that this becomes an open-ended commitment. The U.S. could inadvertently become Argentina's permanent lender of last resort, a financial sugar daddy trapped in a toxic relationship, perpetually pouring money into a bottomless pit to keep its partner out of the arms of a rival. So let's sum up this masterpiece of financial high drama. 1. The play, a politically motivated, high-risk financial intervention designed to prop up an ideological ally before a key election. It's being sold as a repeat of the successful 1995 Mexico bailout but looks terrifyingly similar to the failed 2018 Argentina bailout. 2. The problem, the patient is terminally ill. Argentina suffers from a century of economic mismanagement, political instability, and a deep-seated societal refusal to accept fiscal reality. Its currency is overvalued, its debt is astronomical, and its track record is abysmal. A $20 billion bridge loan is like putting a band-aid on a severed artery. 3. The mechanism: the US is using its treasury slush fund to swap good dollars for bad pesos. It is taking on massive exchange rate risk, betting that a short-term political victory for Milei will somehow magically solve deep, structural economic problems. This is not an investment, it's a spin of the roulette wheel. For the real game, this is less about saving Argentina and more about kneecapping China. It's a desperate, expensive ploy to maintain US financial hegemony in South America and signal that the US dollar is still the only game in town for countries in crisis. For the ordinary audience, this is a cautionary tale about how your taxpayer dollars can be used as pawns in a global chess match you didn't even know was being played. The potential for profit is minimal, and the risk of loss is substantial. For the finance professionals, this is a fascinating case study in the weaponization of central bank assets and the clash between political expediency and economic prudence. Watch Argentina's bond yields, the peso spot in forward rates, and the credit default swaps. They will tell you the real story of whether the market believes this bailout is a credible solution or just more fuel for the next bonfire. Ultimately, the Trump administration is betting that a jolt of US dollars can rewrite 100 years of history. It's a bet that political will can triumph over economic gravity. And as we know here at Boss Economics World, gravity always wins in the end. This isn't a lifeline, it's a financial hot potato, and the US taxpayer is the one being forced to catch it. Stay sharp, stay diversified, and for God's sake, don't lend money to Argentina.